Last October, a chip company called A.M.D. granted OpenAI a warrant to buy up to 160 million shares of A.M.D., roughly 10% of the company if fully earned. The shares vest only as OpenAI deploys 6 gigawatts of A.M.D. chips and A.M.D. stock, hits certain price targets. Let's be clear about what just happened. A chip maker is paying its customer in the chip maker's own stock to become a bigger customer. Once you see this pattern, you start seeing it everywhere. Last September, Nvidia announced it would invest up to $100 billion in OpenAI. OpenAI would then use that money to buy Nvidia chips. Microsoft has invested roughly $13 billion in OpenAI and owns about 27% of its for-profit arm. OpenAI, in return, pays Microsoft to rent cloud servers. Microsoft, to run those servers, buys Nvidia chips. Every major player is both investor and customer to every other major player. Which raises a strange question. If most of the AI industry's revenue is coming from the same companies funding the AI industry, how much of this economy is actually independent demand? And how much is the same $100 billion flowing in a loop? Here's the pattern, edge by edge. In September of 2025, Nvidia signed a letter of intent to invest up to $100 billion in OpenAI. The structure was unusual. Every $10 billion would deploy when OpenAI brought another gigawatt of Nvidia systems online, so the investment and the chip orders were linked by contract. Invest, then buy. Invest, then buy. As originally announced, OpenAI also signed a deal with Oracle worth about $300 billion in cloud services over 5 years. Oracle, to deliver that compute, turned around and placed massive chip orders with Nvidia. Oracle's backlog of contracted future revenue jumped to more than $500 billion in late 2025. Most of that growth came from AI contracts. So the dollars start at Nvidia, flow to OpenAI, flow to Oracle, and end back at Nvidia. Microsoft runs the same play, with a twist. Microsoft has invested roughly $13 billion in OpenAI and now owns about 27% of OpenAI's for-profit arm. OpenAI, in return, committed to spending an additional $250 billion on Microsoft Azure. Most of that spend ends up buying Nvidia chips that Microsoft has to install to host the workload. Microsoft invests in OpenAI. OpenAI pays Microsoft. Microsoft pays Nvidia. The loop closes. Then in November, Amazon Web Services signed its own $38 billion cloud deal with OpenAI. Every major cloud provider is now feeding the same center node. OpenAI sits in a web of commitments where billions flow in one door and billions flow right back out another, to vendors that are often the same companies on the other side of the web. If the pattern is still feeling abstract, there's one company that makes it impossible to miss. It's called CoreWeave. It rents out Nvidia GPU clusters. And the financial paperwork it filed with regulators reads like somebody drew the diagram first, then built the company around it. CoreWeave buys its chips from Nvidia. Nvidia owned around 7% of CoreWeave at its public offering, and after adding to that stake in January, now holds closer to 11.5%. Nvidia also signed a contract to spend $6.3 billion backstopping any unused CoreWeave capacity through 2032. So Nvidia sells chips to CoreWeave, holds a growing equity stake in CoreWeave, and has promised to be the buyer of last resort if CoreWeave can't find renters. 3 arrows pointing 3 directions, all between the same 2 companies. Now the twist. Who are CoreWeave's actual customers? For the last 2 years, Microsoft has made up close to 2/3 of CoreWeave's revenue. So Microsoft, which already owns a big chunk of OpenAI, also funds CoreWeave, which buys Nvidia chips, which Nvidia sometimes buys back through the backstop, while holding equity in CoreWeave the whole time. You can draw this as a triangle. The arrows make a closed shape on the page. At this point, the natural question is, how much revenue is actually coming into OpenAI from outside the loop? From customers who aren't also investors. In November of 2025, OpenAI's CEO, Sam Altman, said something that briefly stopped the conversation. He said OpenAI had committed to spending about $1.4 trillion over 8 years, mostly on compute. Against that, OpenAI's revenue was running at about a $20 billion annual pace. The total commitments were roughly 70 times its yearly revenue. Spread across 8 years, that still meant OpenAI was signing up to spend about 9 times more per year than it was earning. every year for 8 years. That number was so large that in February of 2026, OpenAI quietly told investors the real compute spending target was closer to $600 billion by 2030, with revenue projected at around $280 billion. Smaller. Still staggering. And in March, Nvidia's own CEO Jensen Huang ruled out the original $100 billion deal. Instead, Nvidia put $30 billion into OpenAI's latest funding round, which Huang said is likely Nvidia's last investment before OpenAI goes public. The numbers at the center of the loop are still moving. They keep getting marked down. Even with the revised targets, OpenAI is committing to compute spend that adds up to roughly 30 years of its current annual revenue. For comparison, even Amazon's current AI data center build-out, one of the largest corporate capital programs in history, only runs at about 25 to 30% of Amazon's revenue. Not multiples of it. The only way the math works is if either OpenAI's real revenue grows explosively fast, or the companies it owes money to keep getting paid in stock. So far, most of the loop is being paid in stock. Now, before you conclude this is obviously a bubble, there's a set of numbers pointing the other way. Any honest version of this story has to include them, because real customers outside the loop are writing very real checks. Anthropic, the maker of Claude, hit an annual revenue of about $30 billion by April of 2026. Briefly, more than OpenAI. 8 of the Fortune 10 largest companies in America are Anthropic customers. Over 1,000 companies pay Anthropic more than $1 million a year. These aren't loop participants. These are Fortune 500 buyers, writing checks to use AI for real work. And historically, big infrastructure build-outs have always looked a little insane up close. Canals in the 1790s, railroads in the 1840s, fiber optic cable in the late 1990s. Companies invested far ahead of the revenue. Many went bankrupt, but the infrastructure they left behind powered the next century. So the question isn't really whether AI demand is real, it clearly is. The question is whether it's real enough and soon enough to pay for what's being built. There's one historical episode veterans of the 1990s keep bringing up. In the late 90s, the biggest telecom equipment makers, Lucent and Nortel, started lending money to their own customers. New startup phone companies would take the loans and immediately spend them buying equipment from Lucent. Lucent booked the sales as revenue. Its stock peaked at roughly $260 billion in market value. Then the startup customers ran out of money. Many went bankrupt. They couldn't pay back the loans. Lucent had to write off the debts. The revenue it had booked turned out to be, in a sense, loan from itself. The stock collapsed. The company eventually disappeared into another firm, and Nortel went bankrupt outright. What's similar today is the shape. Suppliers investing in customers, so customers can keep buying. What's different is the scale of real demand. Lucent's customers had almost no revenue of their own. OpenAI and Anthropic have tens of billions growing fast. So this doesn't have to end like Lucent. But the mechanism that broke Lucent, revenue that leans on your own capital, is absolutely present in the loop today. So if you want to know, in real time, whether this is an infrastructure boom or a hall of mirrors, watch one number: how fast OpenAI's revenue from outside the loop grows. Not the commitments, not the stock deals, not the valuations, the cash coming in from customers who aren't also investors. That single number is the difference between the next Amazon and the next Lucent. Everything else is paperwork.